So here now we're going to take a look at the 2020 COVID crash. And without the market tools, it would have been really difficult to become very bullish in the market near the lows. However, that's why you need really tools for all types of market environments so you can really be able to adapt, because the best buys usually come around when most people are not looking. And what's obvious in the market is rarely ever right. So having those tools at your disposal is such a powerful thing to have. So let's take a look here. And I really want to show you how you could have built a position with different stocks, keeping your risk controlled in all stocks at the same time, and you would have been able to own all these major winners for their substantial runs higher with that limited risk. Let's take a look. So we're not going to go through the entire life cycle here. We really did that with Apple and Deckers. What I really want to show is how all of these come together in real time. So I brought up 4 of the major winners of the COVID pandemic, which is Trade Desk, SE, which we covered many times in this course already, Peloton, and Fiverr. All of these stocks really benefited from either the work from home or the increase in digital advertising or e-commerce. Really, these were all the winners from the fact that people couldn't really leave their house very much. Now you can see I was exiting the market in late February on this break lower here because the market really started to show these net new lows and the market conditions were really deteriorating. Even on a daily chart, it became fairly obvious that all the stocks were breaking down. So you should have been out of the market when this kind of catastrophe took place here in the marketplace. But soon after, all the market tools start to very quickly shift to positive. Now, all these 4 charts show the exact same time period, so you can kind of they're overlapped, so you can compare how one stock was acting versus another at the same period of time versus the market movements. And you can see here, as trade desk broke lower, this is where the Federal Reserve announced their QE and all of those extremely dovish programs. So you can see as soon as the Fed stepped in to provide QE, the number of net new lows really started to disappear and the market started to firm up. And you see that in all of these charts, these stocks were really bouncing off of their low as soon as by the time the Fed QE started to show up. In addition to that, even though you didn't have net new highs yet, you start to have kind of like a neutral back and forth here where you had one day of net new highs. So there was kind of an initial sign that the market was strengthening, but you soon after had a beautiful follow-through day that came into the marketplace. And you can see where that follow-through day occurred for all these different stocks. Now, what's interesting is that not all the stocks reacted on the follow-through day the same way. I mean, Trade Desk had a great day up. We had a great move higher here on Peloton. Fiverr barely budged that day. So it's really interesting how when these market signals come in, you really still want to use all of your individual tactical buys because you want to react when the market is also reacting to that stock. You want to see those institutions piling into your stock and you want to run in there with them. So if we start first with the Trade Desk, on the follow-through day, we did have this great move higher, but unfortunately we're below our 200-day moving average. We can't forget our primary principles. We're not going to start buying the stock, or what I'll call dumpster diving here on a stock that's really beat up because it's below its 200-day moving average. And you'll see a lot of these other stocks like Fiverr and C were not below the 200-day moving average. So if you want to react to a stock on the follow-through day, the stock to buy would have been C limited. And so you could have initiated here on this 3-touch trend line break and this kicker, and you would have bought 10% of your AUM. I'm assuming here 30% exposure per stock of account equity. And so we had this gap up here, this kicker 3-touch trend line break. Soon after, we had this 50-day moving average stall recovery. You can see that the stock had stalled the 50-day prior, and here we were able to break above. We covered this earlier with C, and you would not have been stopped out. Soon after, we broke higher again, and we had this great doji flag that kicked in. So rather quickly, you had 30% of your account exposed to one of the real winners of the entire 2020 bull market. And what kicked that off was the follow-through day, the Federal Reserve QE, and eventually the fact that the market started to turn into a more bullish situation. But that's only 30% of your account equity. I mean, you want to be really exposed when the market's about to erupt into a major bull market. So as you're gaining traction with this stock, soon after, the Trade Desk starts to get back above a 200-day moving average. And this also has a 50-day moving average stall recovery. So we bump into the 50-day moving average here, and when we come back around, we break higher here above that 50-day moving average stall. Now, the first buy fails, and I'll be honest, I actually took this initial buy last year, and I was stopped out on this gap lower. However, the next day, we almost had a kicker. It didn't quite kick. I know from experience because I was watching the stock that day, but I did purchase when it took out this high once again because this was kind of another stall of the 50 days. So you had 2 stalls in a row, And so I took that second attempt here, and Trade Desk went on to be a big winner. And many more buys did show up on Trade Desk as one of my full positions for the 2020 rally. So you had 30% exposure through C, you had another additional 10% of exposure through the Trade Desk. And Peloton was also offering some great opportunities. You'll see Peloton actually would have been one of the first stocks you could have purchased. When the Fed announced their quantitative easing, if you want to be buying some stock trying to react to that Federal Reserve activity, you'll see here as the market was making lower lows, Peloton was already making a higher low. Talk about relative strength. This is where all of our tools really come in. And you had this mini coil that developed right here. It was a 4-day mini coil. And the day after the Fed announced quantitative easing, which is a very dovish move, and they really threw the whole kitchen sink at the market to save the market, Peloton was one of the first stocks to move higher here out of this mini coil, and you could have started buying with 10% of your account equity on March 26th. Soon after, it got back above its 50-day moving average, and we formed another mini coil, and this was the day of the follow-through day. You can see on the follow-through day, Peloton didn't really react. So this was not a stock you had to purchase on the follow-through day since you had exposure with C Limited. But a couple of days later, you had your mini coil, and you could have bought another position. You would have had a 2/3 position here at this point, and you would have bought the mini coil. There was also a breakout of this double bottom that formed on the weekly chart. So again, a number of patterns are coming into play here. We had our quantitative easing, we had our follow-through day, we had our mini coil, we had our double bottom breakout, and the market was now also getting back into net new highs, a bullish condition 3 days in a row. So we had our second purchase, we had a 2/3 position here on, and soon after we had a doji flag, and we could have bought our third piece of our position in Peloton, and we had 30% exposure in Peloton, which again was one of the major winners of 2020. So really soon after the market lows, you had a full position in Peloton, you had a full position in C Limited, you had a partial position in the Trade Desk, and that wasn't all. If you were looking at Fiverr, you can see this did not really react much to the quantitative easing, didn't react much to the follow-through day, but then suddenly you had this great big kicker and this moving out, the 50-day moving average volume breakout here on April 8th, and the volume absolutely surged. So there's no reason you had to kind of sit in the stock. Maybe the stock wasn't going to be a big winner and you were just sitting in a stock that was kind of like lethargic at the time, but this break through the 50 really got the momentum going. So you could have put on a 10% position here. And this, I know from experience as well, this gave a lot of additional buy points. This went on to be a major, major winner in the 2020 market. And even having this 1/3 position really gives you that foot in the door, because as you build your position, this low cost entry is always going to keep your average cost down. So as you add to the position later, you're always going to have a pretty wide stop because your average cost is going to be lower. And so that dollar stop is going to be quite a bit lower. And you can see, essentially, you had 80% portfolio exposure between March 26th through April 23rd with tactical buys and shaper buys across 4 leading stocks. And all of these stocks triggered hold rules, and they all became life-changing moves. The exposure was made progressively with controlled risk. And that's how you develop these monster returns, even in extremely volatile and wild market conditions. You can see a lot of people will say like, oh, the market's dropped significantly, let me buy some stock just because the market is down. That's not a way you want to put exposure on. There are safe ways to do it. And if you would have just bought the most beat up stocks like the airlines or the cruise ships, you would not have had the returns that you could have had in these life-changing stocks. And everything was there. If you look at the earnings and the sales, they were booming. They were completely changing the way we lived, worked, and played. They had every criteria you could have wanted. They had relative strength. They had shaper patterns. These stocks delivered every aspect of the system. And you could have held on to these for only a few months and your life would have been changed forever. I know 2020 was one of the best years I ever had. And it was thanks to my refining of the system over many, many years. The system I'm presenting to you has been a work in progress for close to 2 decades, and many nights of sleepless nights and days of euphoria that would then turn bad. And having all of these tools that you can bring together with the backdrop of understanding the Federal Reserve and market activity is just so powerful. So I really hope this is a great example that you can review over and over again. I really recommend you take each of these stock charts or these 4 stocks together, plot out their weekly charts. I want to leave this a bit of as a blank canvas for you so you can do that next step. These were your 4 stocks you could have chosen in the COVID crash. There were many, many, many others. But let's say you went with these 4. I laid out some great initial buys. Go through these 4 stocks. How could you have added to them? How could you have pyramided? What kind of a position exposure could you have had overall following all of your buy techniques, and when did those shaper sells come in. Go through that, figure out how much your account would have changed and how much your life would have been changed in the process. I think you're going to be absolutely blown away.